At the firm, I was paid to read between the lines. And right now, every line is screaming the same thing. The recession isn't coming. It's already here. The government just hasn't told you yet. Here's something most people don't know. The National Bureau of Economic Research, the official body that declares recessions, declared the 2008 recession in December 2008. It had started in December 2007. A full year had already passed. The 2001 dot-com recession, it began in March. They declared it in November. 8 months later. That's not a bug. That's how the system works. Official declarations are always, by design, looking backwards. They confirm what already happened. They never warn you what's happening now. And that's exactly where we are today. The headline says unemployment is 4.4%. The media calls that strong. But to understand why that number is almost useless, you need to understand how it's calculated. The official unemployment rate only counts people who are actively looking for a job within the last 4 weeks. The moment someone gives up looking, they disappear from the statistic entirely. Since the pandemic, more than 1.6 million Americans have stopped looking for work. Gone. Not in the number. Not in the headline. Labor force participation has dropped nearly 1.5% compared to pre-pandemic levels. That's millions of people the official rate simply doesn't see. But here's the problem. It gets worse. Someone working 1 hour a week, delivering food, driving a car, clicking surveys, is classified as employed. Not unemployed. Not underemployed. Employed. Full stop. In the same statistical category as a salaried engineer. In 2025 alone, net new jobs were just 181,000. And of the people who do have work, 4.4 million are working part-time not by choice, but because they cannot find full-time work. Think of it like a hospital reporting patient numbers. The ward looks full. What they don't tell you is that half the beds replaced ICU units with waiting room chairs. The number looks the same. The reality is completely different. Now, look at consumer spending. This is the one the media loves. When spending goes up, the headlines celebrate. Strong consumer, resilient economy. But there is a question no one is asking. Where is that money coming from? Because as of the end of 2025, Americans were carrying $1.28 trillion in credit card debt. A record, not a modest record, a record by a significant margin. And that debt is sitting at an average interest rate of around 22%. At the same time, the personal savings rate, the percentage of income Americans are actually putting aside, has collapsed from a historical average of 8% down to just 4.5%. What this tells you is not a story of a strong consumer. It's a story of a consumer who has run out of runway. People are spending, but they're spending money they don't have at interest rates that compound faster than most investments return. I saw a version of this in 2007. Consumer spending looked fine. The headlines were positive. Then the credit stopped. And then everything stopped. Back at the firm, we had a name for this pattern. We called it the last mile. The final stretch of apparent stability before the data catches up with reality. Before I get to what I think is the most important indicator of all, the one institutional investors actually track. If you haven't already, consider subscribing. What I'm about to show you is not in any mainstream financial headline. There's an index called the Leading Economic Index. Unlike GDP or unemployment, which tell you what already happened, this one is specifically designed to predict what comes next. It tracks things like manufacturing orders, credit conditions, and consumer expectations. It has declined for 6 consecutive months. At the same time, commercial bankruptcies rose over 7%, with more than 24,000 filings, the highest level in over a decade. These are not small businesses struggling. These are companies with assets, with employees, with credit lines. And they are failing at a rate the economy hasn't seen since the last major downturn. Now, take all of this together. Declining labor quality, record consumer debt, collapsing savings, a predictive index falling for half a year, corporate bankruptcies surging. No single indicator proves a recession, but together, they form a pattern I've seen before, and the pattern has a name. In 1975, a British economist named Charles Goodhart observed something that became a foundational principle in institutional finance. The moment a metric becomes a target, it stops being a good metric. What does that mean in practice? When governments are judged by unemployment numbers, they stop trying to create good jobs. They start optimizing the number. One full-time job becomes two part-time jobs, and the number improves. A gig worker with 1 hour of work per week gets counted, and the number improves. When GDP becomes the target, it doesn't matter whether growth is debt-driven or income-driven. Both go in the same direction on the graph. The metric looks fine. The underlying reality is something else entirely. This is not incompetence. It is a structural flaw built into how we measure economic health. And it creates blind spots. Exactly the kind of blind spots where recessions hide until they can no longer be hidden. So the next time you see a headline about strong job growth, ask what kind of jobs. When they report wage increases, check it against 25% cumulative inflation since 2020. When consumer spending looks resilient, check the credit data behind it. The official declaration of a recession will come. It always does. Boom. Bust. Repeat. The information was always there. Most people just weren't looking. Now you are. If this changed the way you see things, tell me in the comments. I read every single one. And if you want to keep seeing what the headlines won't tell you, subscribe. I'll see you in the next one.